Hello, I'm Marcus Brix with the CattleFax Closing Bell. Today's Closing Bell is sponsored by IMI Global, third-party verification and value-added services you can trust. Over the past 2 weeks, global leaders from the United States, the European Union, and the Middle East have held discussions about restarting the Iran nuclear deal. First signed in 2015, the deal would restrict and regulate nuclear power generation in Iran in exchange for removing the sanctions against the country's crude oil exports. Sanctions were reintroduced in 2018, once again blocking Iran from exporting crude oil and setting the stage for expanding U.S. crude oil export business. In the past 6 months, the U.S. has shipped between 400,000 and 500,000 barrels per day of crude oil to India, about 15% of U.S. export volume. While the Iran deal was active, those 400 to 500,000 BPD were supplied by Iran. China is also a major energy export market, which the U.S. and Iran are directly competing, with China already sidestepping the sanctions today. With a restart of the Iran nuclear deal, crude oil volumes supplied to the global market could increase by 1 to 1.5 million barrels per day. While no deal has been confirmed yet, energy markets responded with a cautious expectation for larger supplies in the short term. Brent crude oil futures are testing the 57-week spot market uptrend after losing almost $2 per barrel on the week's trade. Larger supplied volumes of heavy crude will narrow the price premium Brent holds over WTI crude by 2 to 3 percentage points on average. Prices were generally softer across the entire energy market complex. Both RBOB and heating oil futures closed roughly 5 cents per gallon lower this week. Also, spot natural gas futures closed lower this week after a 5-week stretch of higher weekly closing prices. Ethanol futures have been flat for the past 4 weeks, around $2.35 per gallon, despite the quickly breaking corn futures price. June corn futures lost 20 cents per bushel in this week's trade as May corn futures expired and the June contract became the spot market. At the monthly highs on May 7th, spot corn futures reached $7.75 per bushel, which means spot corn is more than $1 off of its highs today. Grains all traded lower, with spot soybean futures down 70 cents per bushel on the week, while spot Chicago wheat lost more than 50 cents. Spot live cattle futures traded higher this week after grain prices dropped and Argentina implemented a short-term ban on beef exports. At $117 per hundredweight, June live cattle futures are just on top of the 20-week average. In the cash market, light volumes traded in the south at $118 to mostly $119 per hundredweight, steady to slightly weaker. Fed cattle traded in the north at $119 to $120, with dress trade at mostly $191 per hundredweight, steady to $1 lower than last week. Feeder cattle traded higher after mixed trade early week. The Thursday quote on the CME Feeder Cattle Index was up $2.85 per hundredweight. Thanks for watching. Remember to visit CattleFax.com, become a member, receive the latest market news and analysis.